Have you ever felt the chilling wind of a market downturn? That sickening feeling in your gut as your carefully constructed investment portfolio begins to crumble. Many believe that diversification and dollar-cost averaging are enough to weather any storm. But what if I told you that these safe strategies, so often touted by mainstream financial advisors, often fail to protect your wealth during truly significant market events? The truth is, the market isn't a predictable machine. It's a complex, chaotic system driven by human emotion, unforeseen events, and hidden currents that rarely align with the neat narratives presented in the financial news. We cling to the illusion of control, believing we can forecast the future, predict the next big move, and time the market perfectly. But this is a dangerous illusion, a trap that can lead to significant losses. Think of it like trying to navigate a raging river using only a tattered map. You might get lucky, but the odds are stacked against you. What if, instead of trying to predict the unpredictable, we could leverage the very inefficiencies of the market to our advantage? What if there was a strategy, a hidden playbook if you will, that allowed us to not just survive market downturns, but actually thrive? A strategy employed by some of the world's most successful hedge funds, a strategy rooted not in prediction, but in a deep, data-driven understanding of market mechanics. This isn't about getting rich quick, it's about preserving your hard-earned wealth, navigating the storms, and emerging stronger on the other side. In this video, we'll begin to uncover that strategy, a secret weapon used by the elite to protect their fortunes, a strategy that you too can learn to harness. Are you ready to challenge the conventional wisdom and discover a new path to financial resilience? We've all heard the mantra, diversify, diversify, diversify. Spread your investments across different asset classes to minimize risk. Sounds sensible, right? But what happened in 2008 or during the initial COVID-19 market crash? Even meticulously diversified portfolios suffered catastrophic losses. Why? The problem isn't with diversification itself. It's with the type of diversification. Traditional diversification strategies often fail to account for systemic risk, the risk of a widespread market collapse stemming from interconnected vulnerabilities within the financial system. Think of it like this: if you have a basket of apples and a disease wipes out the entire apple crop, diversification doesn't save you. Your entire basket is worthless. During systemic crises, seemingly unrelated assets often move in lockstep. The correlation between stocks, bonds, and even seemingly safe havens like gold can increase dramatically, negating the protective benefits of traditional diversification. You might have been spread across different sectors, but when the entire market plunges, your investments will likely follow suit. Relying solely on so-called safe assets, like government bonds, during periods of unexpected inflation or interest rate hikes can also be disastrous. These assets, typically considered low risk, can lose significant value when inflation outpaces their yield. The illusion of safety can be a cruel deception. The secret strategy we'll explore isn't about abandoning diversification entirely. It's about moving beyond this simplistic approach and focusing on something far more profound, identifying and mitigating systemic risks. It's about understanding the hidden connections within the financial ecosystem and positioning your portfolio to not just survive, but to potentially thrive, even during the most turbulent market conditions. Market downturns aren't just about falling prices, they're about mass psychology. Fear grips the market, driving irrational behavior. Investors, swept up in the herd mentality, sell indiscriminately, often at the worst possible time. Driven by loss aversion, the pain of a loss feels far greater than the pleasure of an equivalent gain. This creates a powerful, self-fulfilling prophecy. Fear fuels selling, which fuels further price declines, creating a vicious cycle. But within this chaos lies opportunity. This is where contrarian investing shines. While others are panicking and selling, the shrewd investor sees a chance to buy undervalued assets at deeply discounted prices. This isn't about reckless speculation. It's about leveraging the emotional excesses of the market to your advantage. History is replete with examples of hedge funds that have profited handsomely from market downturns by employing this contrarian approach. They patiently analyze the market, identifying companies with strong fundamentals that have been unfairly punished by the panic selling. They understand that market sentiment is often wrong in the short term, but fundamentally sound businesses eventually recover. This contrarian strategy isn't just about gut feeling. It's a blend of quantitative and fundamental analysis. Sophisticated quantitative models can help identify statistically undervalued assets, while rigorous fundamental analysis digs deeper, examining a company's balance sheet, cash flow, and competitive landscape to assess its long-term viability. However, this strategy demands patience and unwavering discipline. It requires resisting the urge to join the stampede, to sell when everyone else is selling. It's a test of emotional fortitude, a battle against the primal fear that drives panic selling. The rewards are substantial, but only for those who can maintain their composure amidst the storm. Imagine profiting from a market decline. It sounds counterintuitive, but that's the power of short selling. Instead Instead of buying an asset hoping its price will rise, you borrow it, sell it at the current market price, and hope to buy it back later at a lower price, pocketing the difference. It's a powerful tool, often misunderstood and feared, but when used strategically, it can be a potent weapon in your arsenal. Short selling isn't just about profiting from declines, it's a vital hedging strategy. By strategically shorting certain assets, you can offset potential losses in other parts of your portfolio. Think of it as insurance. You're paying a small premium, the cost of borrowing the asset, to protect yourself against significant losses. Many hedge funds have employed short selling to remarkable effect during market downturns. They've identified overvalued or fundamentally weak companies poised for a fall, shorting their stock and limiting overall portfolio losses, even generating profits while the broader market tanked. This isn't about betting against the entire market. It's about strategically identifying specific vulnerabilities. However, short selling isn't without risks. The potential for losses is theoretically unlimited if the asset price unexpectedly rises. This is why thorough due diligence and robust risk management are paramount. You need a clear understanding of the underlying asset, a well-defined exit strategy, and a tolerance for potential losses. It's a sophisticated tool, not for the faint of heart. The potential rewards are significant, but only for those who approach it with careful consideration and discipline. While short selling offers powerful risk mitigation, it's not accessible to every investor. Fortunately, there are alternative strategies you can employ to protect your capital during market downturns. Options strategies, for example, offer a sophisticated way to manage risk and potentially profit from market volatility. Put options, in particular, act as insurance against price declines. By purchasing a put option, you acquire the right, but not the obligation, to sell an asset at a predetermined price, limiting potential losses. Stop-loss orders are another valuable tool. These orders automatically sell your asset when it reaches a predetermined price, preventing further losses if the market turns sharply against you. They're a simpler, more straightforward approach than options, but equally effective in limiting downside risk. Imagine incorporating put options on a portion of your stock holdings. If the market falls, your put options will offset some of your losses. Simultaneously, you could utilize stop-loss orders on other positions to automatically sell if prices drop below your risk tolerance. These strategies aren't mutually exclusive. You can combine them to create a multi-layered defense against market volatility. However, remember that every strategy has limitations and potential drawbacks. Options strategies involve complex calculations and carry potential losses if not managed correctly. Stop-loss orders, while simple, may not always execute at the precise price you set, and they can be triggered by temporary market fluctuations. Careful research and understanding of the risks are crucial. The key takeaway is that protecting your wealth requires continuous learning and adaptation. The market is dynamic, and your strategies must evolve to meet its ever-changing conditions. Embrace education, stay informed, and refine your approach as you gain experience. This journey of financial mastery is a lifelong pursuit. A truly resilient portfolio isn't about chasing the highest returns. It's about preserving capital during market storms and steadily growing wealth over the long term. It's a balanced approach, combining the principles we've discussed: a measured approach to diversification, a contrarian mindset, and strategic risk mitigation. Building such a portfolio is a multi-step process. First, define your risk tolerance and financial goals. Are you investing for retirement, a down payment on a house, or something else? This will determine your asset allocation. Diversify beyond traditional stocks and bonds. Explore alternative assets like real estate, precious metals, or even certain commodities, depending on your risk appetite and research. Regular rebalancing is crucial. As markets fluctuate, your portfolio's asset allocation will drift. Rebalancing involves selling assets that have outperformed and buying those that have underperformed, bringing your portfolio back to its target allocation. This helps to lock in profits and re-establish your desired risk profile. Your risk tolerance might change over time. As you approach retirement, for example, you may choose a more conservative approach, reducing your exposure to higher risk assets. Regularly review your portfolio and adjust your strategy accordingly. It's a dynamic process, not a static one. Building a resilient portfolio is a journey, not a destination. It requires continuous learning, discipline, and a willingness to adapt to changing market conditions. The strategies discussed aren't guarantees of success, but they provide a framework for navigating market uncertainty and building long-term wealth. Begin your journey today. Start by reassessing your current portfolio, identifying its vulnerabilities, and taking concrete steps towards greater financial resilience. Market downturns are inevitable. They are a natural part of the economic cycle, a recurring rhythm in the symphony of finance. But while market declines are predictable, the severity and duration of each downturn are not. What is predictable, however, is the fear and uncertainty they unleash. This fear often leads to rash decisions, emotional selling, and ultimately, significant losses. This video wasn't about predicting the unpredictable. It was about building resilience. The secret strategy isn't a magic bullet. It's a framework, a mindset. It's about continuous learning, critical thinking, and a willingness to challenge the conventional wisdom. It's about understanding the underlying mechanisms of the market, recognizing the psychological biases that drive irrational behavior, and employing strategies that mitigate risk and protect your hard-earned capital. Remember Benjamin Graham's emphasis on long-term value investing. His approach wasn't about timing the market. It was about understanding intrinsic value and patiently waiting for the market to recognize it. This long-term perspective, coupled with strategic risk management, is the bedrock of sustainable wealth accumulation. The power of compounding, the magic of time, works its wonders only for those who can weather the storms. Don't be swayed by the noise of the market. Develop your own independent thinking, question the narratives presented by mainstream media, and seek out diverse perspectives. Don't blindly follow the herd. Find your own path. The journey to financial mastery is a solitary one, but it's a journey filled with immense rewards for those who have the courage to forge their own way. You now possess the knowledge to navigate market uncertainty. You understand the limitations of traditional strategies, the power of contrarian investing, and the importance of risk mitigation. You have the tools to build a resilient portfolio, one capable of weathering the storms and growing steadily over time. Embrace this knowledge, apply it wisely, and embark on your journey towards building sustainable wealth. The future of your financial well-being is in your hands. What will you choose to do with it?